Hello, I'm Anthony Curcio, a senior partner at Summit. For more than 2 decades, Summit has been at the center of credit subsidy and risk estimation for federal lending. Recently, we sense a coming explosion of innovation in credit subsidy modeling, risk analytics, and reporting, and we've recorded 3 conversations to talk about why innovation is needed. First, a little background and history. The U.S. government is one of the largest lenders and credit guarantors on Earth, with more than $5.2 trillion of risk on the balance sheet. This includes more than 24 active loan programs, and some of them are enormous. For example, the lending operations at USDA alone is as large as a top 10 commercial bank. Since the passage of the Federal Credit Reform Act of 1990, risk modeling has evolved through several phases. The first 10 years after FCRA introduced the first generation of present value scoring and risk analytics. Model quality for these early implementers was mixed at best. They lacked automation and were often handmade. Most were built in Excel or even Microsoft Access. In the early 2000s, Congress created more energy and infrastructure programs. These issued large loans to institutions, not citizens. This decade also brought the first widespread use of econometrics and sophisticated predictive modeling, going beyond the use of historical averages to predict loss. From the 2008 financial crisis through COVID, Congress greatly expanded the use of credit by both creating new programs and expanding existing ones. This spike of activity brought investment in a new generation of modeling and analytics. In the last few years, the President and Congress have doubled down on using credit for energy, infrastructure, and nearshoring of manufacturing, attracting policymakers with very strong backgrounds in finance. While some progress has been made, modeling and analytics for risk-based budgeting just hasn't kept up with the private sector. After 35 years of FCRA, too many federal credit programs still rely on disconnected spreadsheets, legacy systems, and manual workflows. This is just inefficient and prone to error. Federal agencies still often lack the in-house technical expertise or bandwidth to build, maintain, and update complex credit models, limiting their ability to perform timely re-estimates, scenario analysis, and policy simulations. Diving into challenges like these, which are indicative of legacy solutions, is why we're having these conversations. But don't worry, we'll also include a hopeful vision into solutions that address these challenges head-on. Kate Lynch Machado, Summit's Director of Strategic Growth, will lead these conversations. I hope you enjoy them.
Hi, I'm Kate Lynch Machado, and this is the first part of our 3-part conversation about the need for more modern commercial solutions for managing the federal government's lending balance sheet, which exceeds $5 trillion. This episode is all about the pain points of legacy credit subsidy models and the urgent need to adopt more commercial platforms and practices. To help us unpack this, I am joined by 3 great guests with deep firsthand knowledge of the pain faced by federal credit loan programs when they analyze and estimate credit. Scotty Senkir oversees the application development team at Summit and has been in the engine room of many credit solutions. Having been at Summit since 2016, he supported the transition of several solutions from legacy platforms and languages to modern, user-friendly applications. He has spent years designing, building, and operating applications to support federal credit functions at agencies like HUD, Housing and Urban Development, Department of Treasury, and Department of Transportation. Sarah Cunningham is a partner at Summit and a former chief of OMB's credit crew. She oversaw the entire federal credit portfolio during the Great Recession and recovery, and later supported HUD's $3 trillion portfolio as HUD CFO. She's led design, implementation, and modernization of credit programs, policies, including the second-generation OMB credit subsidy calculator, credit performance scorecards, and budgetary accounting for better estimates to inform policy decisions. Today, she supports a wide range of credit programs and is a leading voice in federal credit policies. Scott Burrows is the director of Summit's federal credit modeling practice with more than 15 years of experience. Scott has developed subsidy models for more than 20 federal programs. With a background in economic forecasting, he's developed and supported both cohort and loan-by-loan modeling and has taught dozens of staff how to create cash flow models that are compliant with the FICRA and OMB's credit subsidy calculator. Let's get started. So for our first question, we're going to dive a bit into what are the pain points? Why has it been 20 years? What are the consequences of this legacy approach? Scotty, I'm going to start with you. Any thoughts about 20 years, pain points, why now?
Yeah, I think there's probably many ways we could go with that. I think there's the sort of the programmatic requirement aspect of maybe why things have stayed the same, which are maybe correct, right, and justified. I think I'll focus on like the technology standpoint and why we've built models in the same software or same technology stack for as long as we have. Most of it probably comes back to a cost-based reason, right? And sort of the model around if it's not broke, don't fix it, right? And that can be true. I think also within OCIO shops and with federal staff using Excel, Stata, and SAS-based software to build those models has worked. And ultimately the underlying methodologies behind the models is sound, accurate, and reliable. So I think that's why maybe things have sort of stayed the same and slightly upgraded, maybe at a slower rate in the last 20 years. Mm-hmm. But I think obviously in the last 2 to 3 years, as technology has really, I would say, accelerated faster than anyone has thought, I think agencies are maybe starting to rethink, okay, what can we do? And I think that the answer to that is there's a lot you can do, and the cost actually isn't that much more than people think for the value add that you might get out of it. So, but there is the program side of things, right? And maybe why things have stayed the same. Mm-hmm. I think the credit subsidy calculator is another aspect that is something that I think we're on CSC 3.
Yep. That's right.
And, that ultimately does sort of narrow the capabilities of how we model certain portfolios or certain loans. We have to use that, and it's built in a certain technology, which is good. But do we want to change that, right, to make the end user's experience better? So I don't know. I'm sure there's other reasons though that we might have for why programs have done things the same or slightly changed.
Well, and Scotty, I think you touched on one of them, and that is that this has typically been a function that has been an offshoot of either a budget or an accounting line of work. And on budget and accounting, folks are really comfortable in things like Excel, and maybe if they've had a little bit broader experience, maybe things like SAS, and so that's where they're comfortable, and that's where they want to see things. That's the tools that they're used to using, and so that's what they like to see very often. That's one thing that I can think of that might have caused this lag in modernizing.
Sarah, do you want to jump in here? You've been doing this a long time, really know all about legacy systems and kind of what maybe even some of the consequences are?
Yeah, I think both Scotty and Scott 100% have it right. There's also something where, as a budgeteer, that was my first love before I got into accounting, there's a sense of I can figure out how to do this for lower cost. There's a sense of if I can do this in Excel, why do I need to do this? And so part of it is the change management involved, especially when you have to have a model that has gone through every check. It has to go through internal controls. It has to be something that an auditor can look at. Change is scary because then you have to not only get all of your people into a new model, a new methodology of doing things sometimes, but you also have to explain it to the auditor. And so sometimes it's like, if it ain't broke, don't fix it, will lead to smaller fixes that end up layering up and creating some of the challenges that we see with, like, I'll call it a Franken model with a bunch of little fixes kind of stacked up on each other.
Touching on I would maybe rephrase consequences to what opportunities are we missing for a program to improve, right? I think like certain things we see are, persistent data storage around a program and a portfolio over time. Like some of those technologies we referred to before, and looking at historical trends in a portfolio. But with those technologies, that becomes the risk starts to increase, I would say, just based on personnel turnover. And we've all seen like a SharePoint folder with 12 subdirectories and labeling of previous years worth of loans and how those things change over time. So I think data storage and how we think about displaying things to users, over the course of 20 years, right? Like if Scott goes to look back at, historical performance 10 years ago, like where is that data coming from? Is it sitting in a SharePoint folder still, or is it in something that's more secure and reliable and maybe underpins, some type of front end facing application that can be seen by many people, not just 2 to 3 staff?
Yeah, really, really helpful to kind of picture that. And so thinking about that around the technical debt and thinking about, as you described, where things are and how to move forward, do you feel like that has slowed innovation? We talked about at the beginning, you alluded to, Scotty, kind of things around, hey, now we're starting to see more innovation. Are you seeing that after 20 years? Has it been probably some innovation through those 20 years, but now I feel like it's a bit of an explosion?
Yeah, I think, with technical debt, so just for, for listeners and viewers, technical debt in this case is referring to the future cost and rework required for taking an easier or suboptimal approach in building something, right? So, there's countless examples I'm sure people can think of, but it's taking the shortcut to get something done in time that's still accurate and still does the job, but ultimately maybe is more difficult for Sarah to come in and see after I depart to go do something else, right? How reproducible are my results ultimately? So I think that is a real thing, right? That we see on in different programs. I think in terms of slowing innovation, I think this gets a little bit too. It's a little bit tougher, right? Because oftentimes we think about like you hear the expression the simplest solution is often the best solution, which is true. I think the perception around technology now is that, and rightfully so, right? Things are complex, but it's not so complex that we shouldn't pursue certain pieces of a new technology or a new methodological approach. So I don't know. I think there's a lot of ways we can go with that, but those are just my quick thoughts.
Yeah, and I think you raised the point earlier, Scotty, about cost. And I think that's one of the biggest challenges with innovation. My friend calls it the theory of the boring, right? So it's really, really hard when you're trying to do this huge programmatic mission, sometimes to get OMB or Congress or others on board with investing in the technology, with investing in what you need, the change management to be able to do even if it's to simplify what can be a really large change when you've got 20, 30 years of history in some of these programs. So I think cost sometimes ends up being a barrier.
And I think maybe with that, on the innovation piece, like something that we've started to see more of is you need the communication interaction between the programs and us and OCIO shops. And I think more successful innovations take place when there is communication and collaboration ahead of time with those entities, right? Because ultimately you need, if you're going into let's just say like the cloud computing space to utilize some of those resources, taking advantage of those requires some type of support from OCIO. And I think when those things happen, we see more expedited innovation. And when you don't, it's maybe longer and more painful for all parties involved.
Yeah. Well, it's interesting to talk about pain for a while, but we're going to move a little bit to key person dependency on bespoke credit models. And so, Scott, I'm going to talk to you about that because I think it's interesting to see, technology as kind of being legacy technology and kind of thinking about innovation. But often there's like individuals that are the key piece of that puzzle, and how do you think about working around that? And how do you move that system from key person dependency around unique models to something that's more innovative?
Yeah, it's a incredibly common issue in the federal programs we've supported and those that we have a view on as well. Almost all of them each program is unique. They have their loans, their portfolio has unique characteristics that need to be modeled, and they have to be handled in different ways. And that leads to customized kind of modeling where you start with kind of the baseline understanding of how to model a loan-by-loan program, or how you tend to model a portfolio program. But then they all need subtle tweaks and customizations, and that leads to a person or a small group of people who really have the experience and the understanding of how things are being done and how they've been done in the past. And this it leads to that buildup of sole person dependency.
Yeah.
And that, I think we've all experienced issues where circumstances in our careers where we've, of course, had to go through a situation where we've lost that sole person. And that's, I think, we were talking about this earlier, that's particularly acute in the federal space right now, as this has been a year with a lot of turnover. Yeah. And our programs are feeling this probably most acutely, and they have in, than they have in years prior. And that's kind of part of why the subsidy, we talked about, why there's been kind of a lack of focus and modernizing things. And in some ways, the subsidy scoring, be it, obligation scoring, reestimate scoring, what have you, tends to be at the tail end of a chain of a lot of different really important aspects of work in a lending program. So, for example, in a loan-by-loan program, you are going to have an iterative process of negotiations and financial modeling, origination work that is incredibly complex, and as I said, iterative. And at the tail end of that is going to tend to be a handoff between a team that is focused on that work and to a team that is focused on the subsidy modeling. And it's in that handoff, because the subsidy modeling team has the modeling expertise and the origination team has a lot of financial background, et cetera. That handoff is fraught. And it is where we see a lot of errors occur just in lack of communication between those parties, where if in lieu of that kind of customized, very, as you said, kind of slowly built, slowly customized modeling infrastructure, you had the first line team, the originators, or the portfolio management team had direct access to a model that was easy to use and had these characteristics baked into it, and so they could very quickly take what they know about the individual credit, for example, or their portfolio, and drop those characteristics, those inputs into a subsidy engine. They can very quickly, on their own, potentially with a little bit of help from a modeler who might be able to guide them the right way, but they have direct access to things, whereas there's less of that handoff risk and less of that. It is both a kind of a schedule constraint in that it takes time to do that handoff, as well as, more importantly, it introduces the possibility of errors due to miscommunication. So that's kind of, we started with single person risk or concentrated knowledge risk, and I think it gets broader to having the subsidy component of federal lending programs isolated versus fully integrated into the other work that like I said, portfolio managers, risk managers, origination teams are doing.
Yeah, Sarah, you have likely seen the impact of this firsthand over all these years in federal credit, and want to get a sense for you to share with us what is needed to guide policy around these issues and the decisions.
Yeah, I think kind of going back really quickly to a point that Scott said, just so I don't lose it, because I think it's a really good one, is thinking about the need for good data across the credit life cycle. It's not just origination. It's not just when you're trying to close it out or when you're doing re-estimates. The data that we need for good credit management is to inform budget formulation, is to say, hey, Congress, this is how much we're going to get in terms of mortgages, student loans, businesses, and things like that. It's to inform when we're trying to understand how well we did at forecasting the budget. You know, we re-estimate. Are the costs going up or down? Why? Are they going up because of a modeling error? I hope not. Are they going up because there's been a change in the economy? Are they going up because we made an assumption about how certain loans would behave that turns out to be wrong? You know, it's being able to have that traceable data, being able to have a system where, to both Scotty and Scott's point, multiple people have access. People are looking from that common source of data is critical to being able to understand how a program is performing, to inform how much you need to continue that work. What are the opportunities for continuous improvement? And also, what are some of the opportunities to say, oh my gosh, looking at this, are there ways that I can limit risk? You know, as I'm seeing the portfolio change, if I'm looking at some of my data indicators, my re-estimates are going up. It's due to interest rates, but I'm also seeing some borrower behavior changes. That gives critical information to policy officials to say, how do I respond? Is it okay that the risk is going up because these people need additional subsidy to keep this sector going? Or is it something where, whoa, I want to tap the brakes? We had a really great example at HUD. I want to say it was in 2009 or so. Scott, you can correct me. But we found out that they had seller-assisted down payments on some of the mortgages. And so because the sellers of the homes were helping with the down payment, the actual appraisals were inflated. It drove a huge amount of unnecessary cost and put borrowers in a place where they couldn't afford homes. They were underwater through no fault of their own. It was a really great example of being able to have data that was being used effectively to inform policy. And so it's something that really has to cover the entire life cycle. It can also include when you're thinking about servicing loans. Like if I have underestimated the risk, and suddenly now I have thousands of troubled loans that require more work to be able to service, I need to hire administrative appropriation. I need to be able to have more people providing assistance, trying to figure out modifications, workouts, to preserve the value of those loans. Otherwise, I'm putting the taxpayer at further risk. And I've got borrowers who are not able to achieve whatever goal that loan was hoping to get, whether it's economic development, an education, or a home. So it really, the need for data is throughout the entire life cycle, from budget to planning, provides evidence that you need to be able to think about strategic changes as your program review, enterprise risk management for effective management of credit programs.
Yes, Sarah, it makes me prompt on this subject of, you know, key person dependency. And when you talk about data and we talk about the different array approaches, it seems to me that people will now have more access to data, more interested, having more innovation. That could prompt those questions. If you're new to this, you don't have to know everything. You can have a system that allows you to be able to ask those questions, look at the data, have those conversations with others in the process.
Exactly.
Is that something that folks would be willing to have, needed?
Oh, 100%. And I think, you know, to both Scotty and Scott's earlier points, if you don't have to spend all the time going through and manually taking data to move from point A to point B, doing all the QC to make sure that you didn't make a mistake in those handoffs, whether it's a handoff from program to the budgeteers or from accounting to the budgeteers or any of the different handoffs that might occur, that frees up a ton of brain power to say, why are things happening the way they're happening? Right. What could we do better? Yep. How is this working, and am I finding the impacts? And that is where the real value from data-driven credit program management can come from. That's where you can really find the value in the portfolio management and be able to advance your policy goals and potentially at lower cost.
Yeah, I think that's exactly right. And I was going to say, having that direct access without the handoffs means, especially if you're, and Scotty, you were talking about cloud-based systems, which are where a lot of things are heading, obviously. The ability for policymakers to have direct access to these systems so they can do real-time scenario analytics. Like if they're in a meeting and somebody poses a question about, I don't know, increasing upfront fees, for example, is something that happens and exists in a lot of programs. What would the impact of that be, or increasing amortized fees? You can tell in real time, well, let me try that. Click, let that run for 5 seconds instead of a day, and then you can know, and you can have that inform your conversation, not just your policies over the course of many days and weeks.
Yep, exactly. And it's, I think, to build on that too, thinking about it from the public trust perspective, right? Because all of this needs to be audited. All of this has got some oversight, whether it's Congress or someone else saying, how are we doing? I want to know, tell me why. And if you have better data quality, you've got this insight, you're able to generate these and demonstrate an audit trail. Here are the data that are relied upon. Here are the assumptions that were made. Here's the sensitivity analysis we did to understand what the impact of fees would be. It makes it so much easier for audit and oversight to sign off and feel comfortable with things, but it also can help enhance public trust because you don't have those situations where you've got a Washington Post headline that says, oh, wow, my credit program had a massive failure and I didn't know.
Yeah, no, I'm so glad you brought up oversight. It's one of our favorite things too, I think, to talk about, because I think it is one of those areas that you could speed through if you really wanted to and not take a look at all these issues. And all your time in working in federal credit, it's helpful to hear, what are your thoughts in the end about looking at innovation, legacy, technical debt, and legacy model systems, and also how, as things modernize, how does that help that oversight?
Yep. And I think one other thing is thinking about this in the context of how the federal credit portfolio has expanded tremendously. At the beginning of my time in credit in the 90s, we didn't have nearly as much outstanding. You see jump ups in the size of the portfolio in response to economic crises throughout. And when you think about that, the number of programs, the complexity of programs, and even changes within a program, like how many different flavors of student loans are there that need to be tracked within a model. That's where technology is really going to be the only way we can rationalize and get those good estimates to inform good policy.
Yeah. Well, this is great. Thank you so much to the three of you for joining me today on this conversation about pain points and legacy systems and federal lending. I want to offer up that we are going to be back. We're going to move past pain, and we're going to be moving on to some things that might be of more of interest to folks, and move on to some hopeful topics. Please join me for the second part of the three-part series, where we will move into a more hopeful direction around fixing the legacy problems. What does that look like? What is the role of domain experts in moving things forward around fixing pain points? We want to also look at cloud-based AI and how does that impact your work in federal credit, and where does that move things forward around reporting, oversight, what have you. Until then, thank you for listening, and as always, reach out and let us know what you think. Thank you.